Okay. Well, welcome everybody. I'm Jim Masterson. I'm from the Union Township Chamber of Commerce. And this is an incredible presentation that we've been waiting to have for a long time. I've had members who have asked about Social Security. I have members who are nearing retirement or at least close to it and want to find out the information they need to know. We've opened it up to the community and we are excited to have all the participants be a part of this. And we welcome Martha and we want to learn a lot from you today. So take it away.
Okay, this is Debbie from Union Public Library. I'm really happy that you're here. I want to just mention quickly that if you have questions about what's going on at the library regarding construction, you can put them in the chat, or you can sign up for our newsletter, or you can go to our website. So that's my official announcement about what's going on at the library. In the meantime, we are delighted to have Martha Shedden, who is president and co-founder of the National Association of Registered Social Security Analysts, NARSSA, and a chartered retirement planning counselor with her own business, helping retirees make their optimal Social Security claiming decisions. She has over a decade of experience providing Social Security education, consulting, and analysis for individuals and financial professionals, and she's the author of numerous presentations and articles on Social Security. Martha, thank you so much for joining us tonight.
Thank you so much, Debbie. Welcome, everyone. Thank you so much for being here for this presentation. We will be focusing on some of the Social Security rules and claiming decision considerations that are most often overlooked and least understood. And I hope you don't mind muting yourselves during the presentation and jotting down your questions so we can get to those at the end, because sometimes as I go through the presentation, your questions will be answered. So let's get started. The importance of making a smart Social Security claiming decision today is even more important because we're living longer than previous generations, and there's been a shift from defined benefit pension plans to self-retirement funding, which we all are not maybe doing so well as we should be. And of course, we can never really count on specific investment returns from the market. Deciding when to claim Social Security is not a one-size-fits-all decision at all. Every retiree has their own special circumstances, and for many, they rely on Social Security for the majority of their retirement income. Therefore, it is their largest asset. Although they may not realize it, when and how they claim their benefits is often the biggest financial decision that they're facing. There are over 2,700 rules in the program's operations manual for Social Security, and then there are exceptions to those rules. Considering that the average 2021 monthly benefit is about $1,550, which is $18,600 per year, the average person will receive between $300,000 and $400,000 over. Oh my goodness, how long was I muted?
Not long.
I'm so sorry, I don't know how that happened. Was I on this slide?
Yes.
Okay, okay. So I'll just back up a little bit. It is often the biggest retirement asset that we have, because for many individuals, they will collect $300,000 to $400,000 over their lifetime. The majority of retirees, even though this is their largest income, they simply claim as early as possible, and many do need to do that. But we want to make sure they're understanding what that decision will result in. Okay. There we go. No two Social Security claiming decisions are the same, as I mentioned, because retirees are entitled to multiple benefits. Some have pensions that will affect their Social Security income. Others may have minor children or adult disabled children, and many are divorced and entitled to ex-spousal benefits. And if you listen to the media, workers are doubtful that it will even ever be there for them. As AARP noted, Americans are woefully undereducated about Social Security. For most retirees, the Social Security Administration is their main source of information, and yet SSA is not allowed by law to provide personal claiming advice. Information provided by SSA can also be incomplete or even inaccurate. Therefore, almost all Americans do not take Social Security at the optimal time for their circumstances. They just don't have the knowledge and needed to make that best decision, but they're desperate for help about their own claiming decisions. A 2019 study, The Retirement Solution Hiding in Plain Sight, found that 96% of people actually get less than they could have, and that the average household loses about $111,000 over their lifetime. We have only one time to get this right, that claiming decision, so it's important to be informed. There's one do-over allowed, and that is within 12 months of when you claim, and you must pay back any benefits you've received, but then you wipe the slate clean and you get to start all over again. So the presentation will be covering what full retirement age is, calculating benefits, primary insurance amount, reductions and credits depending on when you claim. We'll talk about maximum life expectancy. And then if I have time, I'm going to talk about working while collecting and non-covered pension rules. I like to touch on holistic retirement planning, how Social Security bridges into that, and then the presentation does include case examples. So the first topic is full retirement age, and many people think that is 65 because that's Medicare age, but it's not. It's between 66 and 67, and you can see on the table on the slide here that it goes up by every 2 years between those born it goes up 2 months for every year between 54 and 60, and those born after 1960 have a full retirement age of 67. The full retirement age is the age that we collect what is called our primary insurance amount, PIA, and that is what Social Security considers your full benefit. It's collected on the month and year you turn full retirement age, and if you collect before that down to 62, it's going to be lower. If you collect after that all the way up to age 70, it's going to be higher. To be eligible to collect Social Security benefits, you must qualify by obtaining 40 credits or quarters of coverage. And you can only have collect four in a year. A credit or quarter of coverage is a dollar amount. You can see on the slide, this year it's $1,470. So once someone has received $5,880 this year, they will have their 4 credits. Then Social Security applies an inflation wage index factor to adjust all your past earnings into current dollars. After that, the highest 35 of those adjusted earnings are used, including zeros if you don't have 35 years of earnings. And then a series of formulas correlates that into your PIA, that amount that you collect at your full retirement age. Now, this chart might be the most important one in the presentation. It shows if you collect early, the reductions that will be applied, and if you can wait to claim later, how much it will increase. This chart is for those with a full retirement age of 66. So those are born between 43 and 54. This upcoming, right now, we are updating our NARSA modules to the full retirement age of 67, but this chart shows one for 66. So you can see that the reduction goes down from 5 to 7% if you claim early, and it increases by 8% a year if you can claim later. You can see in this case, someone with a PIA of 2,300 would collect 1,725 at 62. And if they're able to wait till 70, that would be 3,036. So that's a 76% increase in that amount of benefit. I like to talk about life expectancy, and by that we mean maximum life expectancy, because we don't want to underestimate our life expectancy and run the risk of longevity risk, which is running out of money later in life. So this graph shows the probability of living to a certain age. If you're currently 65, you can see for women, they have a 71% chance of living to 80, 31% chance of living to 90. Men, a 60% chance of living to 80 and 20% chance of living to 90. But for couples, at least one will has an 88% chance of living to 80 and a 45% chance of living to 90. So it just goes to show that we often underestimate our life expectancies, and that's not something you want to do with Social Security. Many of the softwares that are out there to maximize your benefits assume a life expectancy of 100 just because of that. So for this graph, what I've put on is an example of someone who's collecting as early as possible, 62, and versus collecting as late as possible at 70. And we are assuming just a $1,000 PIA. So they would claim $750 per month if they started at 62, and that would accumulate up to over $340,000 over their lifetime. On the other hand, if they are able to wait till age 70, and the claiming age is not the only factor in deciding when to claim Social Security. It may seem like that so far, but I have a lot more to share with you. So also on here is what is known as the break-even age. You may have heard of that. And that's the age when, if you started claiming at 70, your total amount would surpass the amount that you would be receiving if you started at 66. But that break-even point, which in this case is 79, is quite a bit lower than men having a 50% chance of living to 85, women to 88, and one of a couple to 99. Now, there's an earnings test, this is called, where if you are between the ages of 62 and that full retirement age, and you're collecting benefits, but also still working, you will be subject to what's known as the earnings test. The earnings test has two thresholds, and those are dollar amounts that apply to certain years, and I'll explain that. So from 62 up to the year that you will turn full retirement age, the benefits will be withheld $1 for every $2 over the lower amount, which is this year is $18,960. For the year that you turn retirement age, those months before you reach the month of full retirement, the limit is $50,520, and $1 for every 3 of those earnings over are withheld. Now, these threshold amounts increase every year. They're higher for 2022. We already know those amounts. And once you reach full retirement age, from that month on, you can work all you want to while collecting Social Security, and it won't affect you. The thing about working and collecting Social Security is you don't lose what they withhold, but you don't want to risk Social Security making a mistake either about what they've withheld, and are they really increasing your benefit to make up for that? Because at full retirement age, they do take into account the months that you had earnings affect your Social Security, and they recalculate your PIA. But it's best to not go there if you don't have to. This is currently a topic that could be, something people need to consider, because people may have lost their jobs or decided to start claiming during the pandemic. I mean, there's all kinds of uncertainty the past 2 years. And so if they started working again, got a better job, or just went back to work at the same place regardless, that might affect them. But they do have the 12 months too, when they could redo their election decision. The next slide talks about what are known as non-covered pensions. And there's 2 rules that have to do with these pensions. The first is WEP, the Windfall Elimination provision. And this affects your retirement benefit if you are collecting a pension. A non-covered pension is a pension that you receive from an employer who did not withhold Social Security taxes. So your payroll check does not show FICA taxes on it, which stands for Federal Insurance Contributions Act, which is the official name of Social Security. So there's many circumstances where this applies for government workers, teachers. I work with a lot of teachers, but they have other years when they weren't working as a teacher or in a government position where they were paying into Social Security. So they're eligible for Social Security and this pension. And there's a sequence of steps that we go through to calculate how much their PIA will be reduced by this non-covered pension. First, retirees collecting both of these determine how many years of substantial earnings that they had covered by Social Security. So substantial earnings, for instance, in 2021, substantial earnings are considered $26,550, but back in 2000, that number was $14,175. So if you have 20 or fewer years of substantial earnings, you would have the most impact on your Social Security benefit from the pension, but it wouldn't totally eliminate it. I think the maximum WEP deduction for this year was about $450. So you would still get some Social Security. It doesn't take it away. On the other hand, the second rule, known as the Government Pension Offset, GPO, this affects people who are eligible for 2 benefits, also a pension based on their own earnings, but on the other hand, a dependent benefit. So that includes spousal and survivor benefits. And the way the GPO works, well, first of all, if you're entitled to your own retirement benefit and also a spousal benefit or a survivor benefit, you're only going to receive the higher of the 2. So it's a dollar for dollar deduction. The pension, the GPO, was set up to sort of mimic that, but it's not a dollar for dollar, it's 2/3 of the pension. So if someone is receiving, say, a $2,100 pension, 2/3 of that would be $1,400. Now, if they're eligible for a $2,000 survivor benefit, that $600 would be deducted from that, and they would receive 1,400, or excuse me, the 2,100. The 1,400 would be deducted from 2,000, and they would receive 600 of the survivor benefit, so 2/3. But in many cases, pensions are large enough that 2/3 of them are bigger, larger amounts than survivor or spousal benefits. So in that case, they aren't able to collect those. The point of the whole education of Social Security is to really be educated and smart about your Social Security election decision. It's not always about maximizing lifetime benefits either. It's about optimizing the decision that is really correct for you and your situation. But you should always understand and pay special attention to the circumstances that apply to you, such as your relationship status, married, divorced, widowed. Women have an extra importance on Social Security. I'll get to that. If you're an immigrant and worked using an I-10 rather than the Social Security number, self-employed, have a disability, or as we talked about, pension. So these are just some of the personal situations that affect people, and those can be compounded with couples who both have different situations. I want to go over some case examples, and this singles are pretty straightforward. You can see here for Helen, she's 60, life expectancy of 90. When we did this calculation, she had a full retirement age of 66 and a PIA of 2,000. So if she claims at 62, she's going to get that 75% of the 2,000, 1,500. But she will collect about 504,000 over her 28 years of retirement. On the other hand, if she waits to a full retirement age, she's going to collect the full 2,000 for 24 years, and that adds up to over 576,000. And at the other end, if she's able to bridge this gap between 62 and 60 or 70, and she's still working, she can wait to claim till 70. She's going to benefit by receiving $2,340 a month, and that's going to add up to a lifetime income of $633,600. You can see that that only applies because she has a life expectancy of 90. So at the same time you're using that long life expectancy, you also want to look at those annual amounts, pay attention to what you'll actually be receiving during those years. Couples should understand spousal benefits because the spousal benefit is 50% of the other spouse's PIA. And a spouse that collects that at their full retirement age will receive that full 50%. If someone collects a spousal benefit between 62 and full retirement age, it's going to be reduced. So for instance, with the full retirement age of 66, the spousal benefit at age 62 is only 35% of your spouse's PIA. In order for one spouse to collect a spousal benefit, their own, the other spouse must be collecting the retirement benefit before a spousal benefit can be collected off his or her earnings record. Also, the only reason you would collect a spousal benefit is if your own retirement benefit is less than the spousal benefit, because all of us, when we go to the Social Security to file for benefits, we are deemed to be filing for all the benefits we're eligible for, and we only receive the larger of the two. Now, spousal benefits apply also to divorced retirees under special circumstances. If they were married more than 10 years, they're 62 or older, they're currently single, then they are also eligible for a spousal benefit based on their ex's earnings. I have two examples of couples, and the first one is a more traditional almost as a one income couple. You can see the wife, Jane, has a PIA of 300. Her husband, John, his PIA is 2,200. Jane has a slightly longer life expectancy. So as the survivor, the couple would want to plan to maximize the higher earner, which is John, his amount, because that is what Jane would collect if she is the survivor. So if they both claim at 62, John would receive that reduced 75% of his 2,200, and that would be 1,650. Jane would receive a spousal benefit, actually, because her own retirement is 300 and the reduced spousal is 770. So she would still receive the spousal benefit whenever John started receiving his retirement benefits. Their maximized lifetime income would come if they both claimed at 70. And in that case, John would be collecting $2,904. Jane would only collect $1,100 because the spousal benefit never goes above the 50%. It's not like retirement benefits that increase up to age 70. Spousal benefits are only 50%. Now, Jane could have started claiming her own retirement benefit before John started, and she could have claimed that, whatever it would be, 300 or less, up until John started collecting. Actually, all the way up to 70, it'd still be less probably. And then she would get that bump up to the spousal benefit when he started collecting his retirement benefit. So you can see how couples, there's a lot more to consider with couples. And as a two income couple, you can see it's a different, easier calculation. Their PIAs are somewhat similar. Terry's is 2,300 and Ted's is 1,900. So their maximized amount would be if they both waited till 70. That may not be the best for their financial circumstances or health reasons or many other situations, but you can see if they both claimed at 62, they'd collect $972,900 over their lifetime. And if they waited till 70, they would collect $1,180,080. Let's see, couples. I'm kind of running up on time here, so I will just point out that there is one couples claiming strategy that is still applicable, but it's only applicable to people who were born in 1953 or earlier. So if there's anyone watching that would like to know about that, please reach out to me and I'll explain that. Now, survivor benefits, I've mentioned, the surviving spouse inherits the larger of a couple's benefits. The survivor can start also collecting earlier as early as age 60 rather than 62. And these survivor benefits are particularly important to consider for couples with great age differences, very, very different PIA amounts, possibly minor children or an adult disabled child. All of those would compound the reason to pay a lot of attention to that survivor benefit. So this next case I'm showing you is similar to the one before, where the wife has a very, very low PIA. Her husband, he can claim, as we saw, 62 to 70 with greater amounts all the way up, and she would do the same, but she would benefit by him claiming at 70. If he started at 62, he would collect $1,650 a month. We're going to assume that Wendy is going to collect at her full retirement age and receive $1,100. So if Bill had started at 62 and was collecting $1,650, she would get another $550 to make her total amount $1,650. And that would give her an increase of about $33,000 over the 5 years as a widow. If he claims at 66, he'd get his full $2,200. And so she would get a bump up from $1,100 to $1,650. And that would, oh, I'm looking at the wrong one. I apologize. That would give her a bump up of $1,100 to the full $2,200. And so that's going to give her an increase of $66,000 more over her 5 years as a widow. And if he claimed at 70, he'd be collecting the $2,904. Wendy would collect an additional $1,804 besides her $1,100. And that would give her $108,240 more survivor benefits as a widow. So that's quite a bit of difference depending on when Bill claims his benefit. I always like to touch on women, because women, Social Security is more important even for them because of a couple of reasons. We have more years out of the workforce caregiving. Historically, we still have lower lifetime earnings. That's definitely changing for younger generations. Often marry men older than ourselves and therefore are the likely survivor. And so making that correct decision for women is especially important. Social Security is really just the first step in a really complete retirement financial plan. I think it should be the first analysis that's done and considered as an asset. But then all other incomes, assets, and expenses, by examining those and the tax liability, medical costs, life insurance, other insurance, long-term care insurance, legal and legacy planning, all of that, along with lifestyle goals and expectations, you can determine the discretionary income that's available if those funds are withdrawn in the correct sequence tax-wise to extend the longevity of your portfolio and give you the highest standard of living in retirement. Part of that is taxation of Social Security income. And a lot of people don't realize their Social Security benefit income can be taxed. Only up to 85% of it can be taxed. And it is also given a tax preference in the calculation to determine how much is taxed. So it's sometimes to your benefit in planning to consider using some of your 100% taxable retirement accounts funds, because those will be required to be taken out at age 62 and above. And by using those earlier, you're trading those 100% taxable dollars for a larger Social Security benefit with a lower tax consequence. That's one of the most complicated factors to look at. So at NARSA, we train financial and tax professionals we educate them on Social Security and train them on using software to do analyses. And they work with clients by first having an initial consultation, doing the analysis, and then providing clients with a number of different options, claiming options to make that optimal decision. And that's how I got started doing this in 2015 with my own business, which I've now kind of turned into the NARSA program. making the smart decision, it can ensure that you receive all that the money that you deserve. And this is an example of just one of the pages from the analysis of the software, what the maximized is and the what if claiming. And you can run any number of what if claiming strategies. So it is possible to receive 20, 50, or even 100,000 more, as we saw. And that's worth taking the time to be educated and to know about that. Here's some resources. Our website, rssa.com, ssa.gov, of course, their website is very, very good. It's just a matter of knowing what questions to ask for, to search for. Center for Retirement Research at Boston College is an excellent resource. And then the National Committee to Preserve Social Security and Medicare. So that's it. I ran over my half hour, but I'm happy to take questions as long as anyone has any.
Thank you, Martha. That's very helpful. And I want to also tell everybody that I'll be sending the slides out following this presentation in a follow-up letter. So you can unmute yourself. And at that point, you can ask a question or you can raise your hand, whatever you like. Does anyone have any questions? It's a lot of information and it's hard to figure out what your own personal situation is. That's for sure.
I don't know if you can see me. I have a question.
Maureen, go ahead.
Hi, I just was curious, at the age of 62, I wanted to just clarify, how much could I earn if I decided to also collect at 62?
Okay, so the 2021 earnings test, I'm looking it up for you. I know it's 18 something. Here it is. This year in 2021, it's 18,960. So for instance, if you earned 28,960 and then you reported that income the next year, Social Security would see that you'd earned 10,000 more over that limit. They would withhold 5,000 from your Social Security checks for that year once they have that information.
So the tops I could earn would be 18,000, blah, 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 blah.
960, and that's going up for 2022 in January.
And they could withhold 5,000, you said? Is that what you said?
They will withhold $1 for every $2 over that amount. So I used a simple example of 28, which is just 10,000 more.
Wow, and then at the age, my full retirement age would be 67, according to the charts. Then you can earn as much as you want and collect.
Yes, that's correct. Starting the month you turn 67.
Okay, thank you.
And that the months before that, it's a much higher amount of 50+ thousand.
Right. Thank you.
I have two questions for you.
Okay.
The first is, bottom line, is it best to discuss this decision to collect with an accountant?
No, it's best to discuss if they're an RSSA.
And just explain what an RSSA
Well,
is again.
it's a, Michael Rosedale and I formed this company about 4 years ago. We launched the program in 2018, and we are training tax, and there are a lot of tax professionals who do have that designation now, tax and financial professionals to do this type of analysis. I got introduced to Social Security back in 2010, 11 actually. I worked as a civil engineer for 32 years, and I learned about Social Security and was flabbergasted at what I didn't understand and how I couldn't figure it out. And so I started teaching classes on it in 2014, and then in 15 I began my own business, Shed and Social Security and Retirement Planning. Michael knew of me because he owns CPA Directory, and so he contacted me, and we formed this organization to make a rigorous program that educates and trains folks to help their clients with this.
Great. Okay, then we have another question from Ileana. Can a 401k distribution affect Social Security benefits at full retirement age?
No, if you're referring about the earnings test, the only earnings that affect your Social Security between 62 and full retirement age, if you're collecting it, are actual earned income that is being taxed for Social Security. So dividends, retirement account distributions, none of those are considered earnings for the earnings test. Is there another way that you thought it might affect after your full retirement age?
Ileana, can you unmute yourself? Ileana? Can you unmute yourself? So ask the question again, Martha.
I was just wondering if she said 401ks at her full retirement age. So I just want to make sure I answered the question. And all of you are welcome on the slides. The last slide, you saw my contact information. You're welcome to reach out to me. The best way is email, because then I keep track of it. I won't lose it.
Which might answer another question. Wait, hold on a second. I'm sorry. Marcia, and you can unmute yourself if you want to ask the question, except that she doesn't have that. Okay. Okay, a minute now. There's a question. Okay, that one. Besides age, what are other considerations, and how can we meet with an RSSA?
Well, besides age, that's a big one, because you saw how it goes up the longer you wait. And that's often the advice many people are given. So it's very important, but also, are you still working? How long do you want to continue to still work? Are you married? Do you have a young spouse or minor children? Because they're eligible for benefits once one of the parents starts collecting retirement benefits. The spouse that's taking care of young children and the children are eligible for benefits based on the retiree's earnings record. And then just your financial outlook, what funds you might have to use in the gap between 62 and 70, if you can try to wait. I mentioned the use of retirement account funds because I think we're all programmed that we created these individual retirement accounts, and we have our employer sponsored accounts, and because they weren't going to be fully taxed till we took the money out when we would have less income. But if you're at the same time trying to maximize your Social Security income, you need to take all of that into account, because your tax liability could really increase at 72 when you're required to take those out. So it doesn't hurt to use some of those retirement account funds to bridge the gap and let your Social Security grow, because it's going to increase in those years, and then it'll be a lifetime amount that will be receiving cost of living adjustments for the rest of your life. So it's like an annuity.
Cipriano, do you want to ask your question? Do you want to unmute yourself? Okay, what about?
Yeah, sure. I'm sorry. I just want to know about health insurance. At 62, you're not eligible for Medicare?
That's correct, not till 65. So you need to bridge that. If you quit working at 62 and you lose your employer-sponsored health coverage, that is a big issue for many people. And if you don't start collecting Social Security, or you haven't started at 65, you will pay those Medicare premiums. It's paid every 3 months until you start collecting Social Security, and then the premiums are taken out of your Social Security check.
Thank you.
Complicated.
Hi, I just have one question. My husband passed away at 60,
Okay.
so he wasn't, collecting Social Security or anything like that. And I've just turned 65 and will be eligible at 66 in 4 months. So now I've gotten several conflicting, like, the information I got was, you either collect one or the other, whichever is higher, as far as the benefit goes, or they told me that there was the survivor benefit. But when I had called to inquire about that, they told me at this time I made too much money because I was still working.
Okay.
And that I wouldn't be eligible, or it would be worth it for me to wait until I retired. I don't plan on retiring, like, anytime soon. I'm going to continue to work for as long as I can.
Okay.
So my question is, like, what do I do at 66 in 4 months? Like, do I start, like, when I called to apply, like, for Medicare and everything, the person I spoke with on the phone said that I could start, I could keep working and get that, and go to, my full benefit, and then collect my full benefit at 66 in 4 months. He recommended that you start at 66 in 2 months, the application process, or I could wait till 70. I mean, I don't know if I want to wait till 70.
Well, you don't. So the increase, I didn't make that clear too. The increase in reductions on that benefit, they're a monthly item. It totals up to 8% a year, but for every month, you're getting more as you wait. And so survivor benefits are special. Like I said, you can collect them as young as 60. You're also able to collect one, the spousal or retirement, and switch to the other when it becomes larger. And there are certain minimums. If you start collecting at your full retirement age, you would receive 100% if he had been receiving it, but a minimum of 82.5% of his full amount, his full PIA. So when he passed away at 60, whatever his PIA was, you would receive 81 or 82.5% of that. And depending on what that amount is compared to your own retirement benefit, then you can figure out when to start collecting what. And that's a really good example of the value of an analysis using software, because we can enter in how long you want to continue working, your wages that you expect to receive, and look at various claiming ages, your full retirement age, 68, 70, anything you want to look at. We look at multiple, they're called what if claiming options. We look at multiple options for our clients. And at NARSA, we do have in-house RSSAs who do this analysis. So if you like to reach out to me, I'll put you in touch. It's exactly what I do in my own business, but I really am not able to do much of my own business anymore because I'm so busy at NARSA. So they were trained by what I went through. So, and they're excellent. We have 3 in-house RSSAs right now. We'll need more.
Especially as we all get older,
Right.
as the population.
Yeah.
What is the software, please?
Well, we use Maximize My Social Security. It's developed by Larry Kotlikoff, economic planning, economic security planning, ES Planning is his company, and I can't remember his solutions or secure. I think it's economic security planning. He's an economist, and he developed Maximize My Social Security. And we train our analysts using that. It's extremely detailed and precise and covers every single hidden rule there is because he's such a detailed person being an economist. So I've used that for years. And they do have a household version for one person. You can, I think it's only $40 or $50. You could get that.
Great.
I have
Okay,
a-
somebody has their hand up. Ron.
Hi. Can you review the income tax ramifications, federal and state and so forth?
Oh, on Social Security income?
Yes, on the Social Security income benefit you would receive.
Okay, so it's a complicated topic, of course. But what happens is once you're retired and you're collecting Social Security, there's an item called combined income. And it's all 100% of your adjusted gross income, and then 50% of your Social Security and any tax exempt interest. And that's called combined income. And then there are thresholds for singles and married, ranging from 20 to 40 something plus dollars. If your combined income is over the lower of those, up to 50% can be taxed. If it's above the upper threshold, say you're married and it's over 44,000, I think, up to 85 can be taxed. But that doesn't mean it will be taxed. There's another series of equations you go through to determine that.
Okay.
And there are 13 states, I believe, that also tax Social Security. And you can easily find those states by Googling that, which states tax Social Security.
Do you know if New Jersey does?
I
Martha,
don't
do you
off
know?
the top of my head. I
Okay.
don't.
Okay, is there another question? And
Thank you.
first of all, Ron, you got your question answered, I hope, before I
Yes,
interrupted?
thank you.
Okay. I'm just looking to make sure I didn't miss anything. Any other questions? Great, time for a Union Public Library commercial. How do you keep track of everything that's going on at the library now that we're in the middle of a move and a transition? How do you know what programs are coming up? Why, the answer is, of course, the Union Public Library newsletter. Sign up by going on the website or by putting your email address in the chat, or I'll send you a letter. And you can just reply to that, an email, you can reply to that, yes. It will come twice a month in your box. You can easily unsubscribe and it'll give you an idea about who's coming up. For example, we have coming up a tour of historic cemeteries. We have Jamie Turner, I think her name is, who does organizing your house with a great sense of humor. We have coming up Weird Science, What About Your Brain, which is the first science program we'll be having. And I hate science and I'm actually interested by this. We have all kinds of things. So check our website, uplnj.org, or email me. And Martha's email contact info is on the slides, Marcia. So I'm going, right, Martha?
Yes, it is. It's on the last slide. You can reach me email. It's very easy. It's Martha@NARSSA, NARSSA.org.
Great. James, do you want to close this out unless there's another question?
Sure. Thank you so much, Martha. We really appreciate that.
You're welcome.
I just want everyone to know that I do have also a copy of the slides that Martha provided. So if you need them, I can email them to you with no problem whatsoever.
And
And
I'll
we're very, very grateful.
send them out also. I'll just send them automatically to everyone, James, if that's
Okay,
okay.
all right.
I see some people would like the slides. Martha, you're a hit. So
Oh,
thank you
good.
so much for helping us out on this evening, which is getting close to your evening, I imagine.
Yes, my pleasure. Yeah, I hope I was coherent because it's late afternoon for me and I'm better in the morning.
Martha, what part of the country are you in?
I'm in California. It's only
Okay.
4 o'clock, but I'm winding down. My team's in New York, so I